Good afternoon, everyone. This is Linda Schechter Manley, General Counsel at New York State Homes and Community Renewal. And thank you for joining me today to talk about the Paycheck Protection Program and specifically how PPP will work for nonprofit organizations. Prior to joining New York State Homes and Community Renewal, I worked for 18 years with Lawyers Alliance for New York, an organization that provides free and low-cost legal assistance to community-based nonprofit organizations. And so I have a great deal of experience working with nonprofits, and I'm very happy to be able to talk with you about how PPP can support your organization as you are helping New Yorkers cope with the COVID-19 pandemic. PPP is a new program of the federal government of the Small Business Administration. And because it is so new, the rules around PPP are evolving quickly. How the program is being implemented is evolving quickly. And so I ask you to check back regularly with ESD and or the Small Business Administration for updates on the rules and regulations. So PPP is part of the CARES Act that was signed into law by President Trump in the end of March 2020. And it's specifically designed to help nonprofits and small businesses who are impacted by COVID-19 to cover their payroll costs in this immediate period when businesses and nonprofits are shut down as we social distance in order to stem the spread of the disease. So eligible nonprofit organizations include organizations exempt under Section 501c3 and 501c19 of the Internal Revenue Code. 501c3 organizations are charitable, education, religious organizations. 501c19s are veterans groups. So you can use the loan proceeds of a PPP loan to pay workers, to pay interest on a mortgage obligation or other debt that existed prior to February 15, 2020, to pay rent, health insurance premiums, sick or medical leave, utilities, and other payroll costs that your organization incurs from February 15, 2020 to June 30th, 2020. The maximum loan value for a PPP loan is $10 million, and we'll talk about how to calculate the loan value that you're eligible for. And very importantly, up to 8 weeks of eligible expenses that you pay from the date of your loan can be forgiven. So that loan principal can be forgiven as well as interest payments accrued on that principal. Any loan amount that is not forgiven gets rolled into a 2-year loan, term loan, at 1% interest. So the basics of PPP. The primary objective of PPP is to cover payroll costs. And that's really something important to keep in mind as we go through the specifics of the program. So PPP will provide nonprofits with loans that may be partially or fully forgiven and that are 100% federally guaranteed. So there's a federal guarantee behind the loan that the bank gives you. PPP relies on existing SBA loan programs, increases the funds available to those programs, changes the terms, streamlines the borrowing requirements, which we'll talk about, and expands the eligible lenders. PPP loans do not require collateral, so you don't have to pledge security behind the loan, and you do not have to provide personal guarantees. Other requirements for SBA loans, like the availability, like proving whether or not credit is available from other sources, do not apply to PPP loans. And the application window for these loans opened on April 3rd, 2020. And here is a link to how you can get the application from SBA. So as we said, loans can be made up to $10 million from participating lenders. And the way you figure out what your loan value is by calculating 2.5 times your average monthly payroll costs up to $1 million. And at the end, I'll walk you through a mathematical example of how you do that calculation. But essentially, you're looking at your payroll costs over the last year, dividing them by 12, and then multiplying that number by 2.5. The interest rate is 1% for a term of 2 years. There are no fees for borrowers to apply. There's no prepayment fee. So, for example, if you were to take a PPP loan and then get a foundation grant to cover that cost, you could repay the loan completely with no penalty. Loan payments are deferred for 6 months, so you don't have to begin servicing the loan for 6 months. Banks have the option of extending that to a full year. In order to be eligible for PPP, you have to have been operational on February 15th, 2020. The loan period is from February 15th, 2020 to June 30th, 2020. If your organization's already received an economic injury disaster loan and you choose to refinance that loan with a PPP loan, the amount of your economic injury disaster loan will be added to your PPP loan, subject to the $10 million cap. And we'll talk about the economic injury disaster loan as an alternative to PPP during this presentation. And you are eligible to apply for this loan until June 30th, 2020. I would urge you, however, to apply for the loan as soon as possible. The funds that are available, while a huge amount of money, $3.5 billion, are going to be awarded on a first come, first served basis. And we assume that there is going to be an incredible amount of demand. So I urge you to apply as soon as your organization is able to put together the paperwork. So what can you use PPP for? As part of the loan application, you're going to be required to make a good faith certification that loan proceeds will be used for payroll costs, costs related to the continuation of group health care benefits during periods of paid sick, medical, or family leave, and insurance premiums, to pay the mortgage interest, not principal, but the interest on mortgages, rent payments, utility payments, as well as interest on any debt obligation that you had prior to February 15, 2020. So if your organization, for example, had a revolving line of credit that was drawn on as of February 15, 2020, and you can use the PPP to pay interest on that revolving line of credit. So who's eligible for a PPP loan? Nonprofit organizations as well as small businesses, but nonprofit organizations exempt under Section 501c3 or 50119 of the Internal Revenue Code that have 500 employees or less are eligible. Both full-time and part-time employees are included in that count. And organizations that have seasonal staff, so if your staff fluctuates during the year, can calculate your number of employees based on the time period between February and June of 2019. Nonprofit organizations are also subject to SBA's affiliation standards. So if your nonprofit organization is affiliated with other entities, let's say there's a parent corporation, an separate corporation that runs daycare programs, maybe an entity that owns an affordable housing development, and an entity that provides senior services. Those three organizations are run and operated by a common board or a board that shares directors, those three organizations would be considered affiliated entities, and you have to add together all of the employees in order to determine whether you come under the 500 employee cap. Another question is, what goes into calculating your payroll? So payroll costs include salaries, wages, cash tips, payment for vacation, parental, family, medical or sick leave, and group health care benefits, as well as other employee-related expenses. Probably for most of these organizations, you're not going to have cash tips, but you may pay an employer share of group health benefits, and that would go into your payroll cost. If you have staff that earn over $100,000 annually, PPP will only cover the cost of their salary up to 100, up prorated over this 8-week period as if they earned $100,000. So if you have an employee that earns $150,000, for purposes of PPP, you calculate them as having earned $100,000, and PPP will cover up to 8 weeks of that $100,000 salary. The organization would have to figure out how to cover the rest. And so the average payroll would be calculated by using one or of a few calculation periods. The easiest is the 12-month period prior to origination of the loan. But we said for seasonal employers, you may have the option of using the period either February 15th, 2019 through June 30th, 2019, or March 1st, 2019 to June 30th, 2019. And for organizations that were not in business for the full year, for a full year prior to February 15th, 2020, you can use the payroll period January 1st, 2020 through February 15th, 2020. Now, one of the key aspects of PPP and one of the primary reasons these loans are so attractive is that the PPP loan can be forgiven. In other words, in essence, it can turn from a loan into a grant. The Act establishes that a borrower is eligible for loan forgiveness equal to the amount spent by the borrower during the 8-week period after origination of the loan on very specific categories of expenses. Those categories include payroll, interest on a mortgage that originated prior to 15/2020, interest on a debt that originated prior to February 15, 2020, payment on a lease, or payment of a utility service. Amounts that are forgiven cannot exceed the value of the principal of the loan, but will also include accrued interest. Loan proceeds that are used for any other purpose will not be forgiven and will become payable within 2 years at 1% interest. No more than 25% of the loan can be forgiven if the expense, let me rephrase that, up to 25% of the value of the loan that will be forgiven can be spent on expenses other than payroll. So let's just say for a moment, you pay 8 weeks payroll expense plus your rent payment. That rent payment will be forgiven as long as it does not exceed 25% of the overall amount of the loan. So if you spend 75% of the loan on payroll and 25% of the loan on rent and utilities, the full value of the loan will be forgiven. If you spend 70% of the loan on payroll and 30% of the loan on rent and utilities, 95% of the loan will be forgiven. That remaining 5% will be payable in 2 years at 1% interest. And I think when thinking about this, it's really important to remember that the primary objective of PPP is to retain your employees at their current base pay. So if you keep all your employees and you pay them up to 8 weeks of payroll expenses, payroll and related expenses, that amount will be forgiven. If you still lay off employees after receiving PPP, the amount of loan forgiveness will be reduced by the percentage decrease in the number of employees. Similarly, if your payroll expenses paid on workers making less than $100,000 a year annually decreases more than 25%, loan forgiveness will be reduced by the same amount. So really think about it this way. If you had payroll expenses in the prior year of $10,000 a month and you retain all of your staff and you continue to have payroll expenses of $10,000 a month for each of the 2 months after you receive the payroll, the PPP loan, the full amount of that loan, right, or the full amount of those expenditures, that $20,000 will be forgiven. If you, let's just for easy math, say you have 10 employees, you pay them each $1,000 a month, and you lay off 2 staff members because of COVID-19, because you have a reduction in services that you're providing or a reduction of funding, and now your payroll expenses are $8,000 a month, but you got a loan that covers $10,000 a month in expenses, it is possible that only $16,000 of the loan will be forgiven because you had $8,000 a month in expenses instead of the 10. If you've already laid off some staff as a result of the COVID-19, of the pause in New York State, and you rehire them after getting the loan, you can still be forgiven for the full value of their payroll expense as long as you rehire them by June 30th, 2020. If the principal amount, the full principal of the PPP loan is forgiven, the borrower is not responsible for accrued interest in that 8-week cover period. And any remainder of the loan that's not forgiven operates as a 2-year term loan at 1% interest. If you've applied for an economic injury disaster loan, which we'll talk about a little bit more, and you already received that loan and want to convert to a PPP loan, you are able to do that. You're in essence, to refinance or pay off the economic injury disaster loan with a PPP loan, and then your PPP loan functions as other loans do. If you took advantage of the Emergency Economic Injury Disaster Loan Program and got an award of up to $10,000, that loan will be subtracted from the amount forgiven under the PPP program. So again, let's say, for example, you got a PPP loan in the amount of $100,000 and you received a forgivable $10,000 emergency injury, economic injury disaster loan in the amount of $10,000. The amount that would be forgiven under PPP would be $90,000, and you would still need to repay that additional $10,000. So what's special about PPP for nonprofit organizations as opposed to small businesses? PPP provides critical financial support for New York nonprofits during this emergency, but there are a number of considerations that you should take into account before applying. For organizations that have reimbursement-based contracts that cover their payroll expense, you have to remember that PPP is also intended to cover payroll expenses. And so you're not going to be able to report both to your lender and to the government that you paid the same employee their full salary using both resources. So let's just say, for example, you have a caseworker that's 100% covered under a government grant. And you applied for a PPP loan to cover, among other things, the payroll expense of that caseworker. For this 8-week period, you're not going to be able to say to the government funder and to the bank that their funds were used exclusively to pay that worker, right? So you may need to speak with either your contract administrator at a government agency, or if you have a foundation grant covering that expense, and try and receive a modification to allow you to use the PPP funds to cover payroll during this time period, and use the grant from either government or from a foundation for another purpose. If you have an employee who's perhaps only partially funded through a government contract, you would be able to use PPP and that portion of the government contract to cover the employee's salary. But again, you're not going to be able to apply to PPP for loan forgiveness for the portion of salary that was covered by the government contract. In considering whether or not to apply for a loan and how much you want to request, you really need to take into consideration the circumstances of your particular organization, including updating the organization's revenue and expense projections in order to understand that the ability of the organization to repay the loan in the event that the full amount is not forgiven. You may also want to review your bylaws and your governance practices to see if a board or committee resolution is necessary. You should review any pre-existing loan agreements you have with a bank to make sure that taking on additional debt would not be an event of default under those loan agreements. And there is a funding cap, as I said, for this program. So if you think PPP is right for your organization, you want to make sure that you apply as soon as you can. So here are some examples about how to calculate the loan value that you're eligible for. So if the organization has no employees making more than $100,000, and your annual payroll is $120,000, your average monthly payroll would be $10,000. You multiply that average monthly payroll by 2.5, you get to $25,000, and that becomes the maximum value of the loan that your organization is eligible for. The second example is if you have employees that make more than $100,000. So let's say your organization's annual payroll is $1.5 million, and the amount of annual compensation that is paid that's over $100,000 is $300,000. You would subtract $300,000 from $1.5 million, and your annual eligible payroll becomes $1.2 million. Your average monthly qualifying payroll would then be $100,000. You multiply that by 2.5 and you get $250,000. And so your maximum loan value is $250,000. So what should you be doing now? You need to start collecting the data that you're going to need in order to apply for PPP. And actually, probably the first thing you want to do is check with your bank and make sure that they are a participating SBA 7A lender. And you can also check that on SBA's website. Because demand for this program is so large, many lenders are only willing to work with pre-existing clients. So you want to make sure that your bank is participating in this program. So the first thing you want to do is make sure your bank's participating. Then you need to start gathering the data you're going to need to make the certifications that are required. For your employees and your payroll expenses, you're going to need to figure out what your eligible expenses were for the last 12 years for wages, cash tips, commissions, other forms of compensation, healthcare benefits, insurance, payment for vacation, parental, family, medical, or sick leave, payment for any retirement benefit, payment for any state or local taxes assessed on the compensation of the employee. The things that are excluded from payroll expense are compensation of over $100,000 as prorated for this period, payroll taxes, so the FICA portion of the paycheck does not get included in this. Any compensation of an employee whose principal place of residence is outside of the United States, and any qualified sick leave wages for which a credit is payable under either the the Families First Corona Response Act, or a qualified family leave wages under the Families First Coronavirus Response Act. So in other words, if you have an employee who's already collecting a federal benefit as a result of one of the coronavirus relief acts, their payroll expense will not be counted. That payroll expense will not be counted in this calculation. Other eligible expenses are interest on mortgage obligations. So that's how you calculate payroll. Here are the other things that you can pay with a PPP loan. Interest on a mortgage obligation that you incurred prior to February 15, 2020, meaning the mortgage was in existence prior to February 15, 2020. Interest on another debt obligation that was incurred prior to February 15, 2020. Rent on a lease. Payments on utilities, including electricity, gas, water, transportation, telephone, internet. So those are the types of things that you can use PPP resources on and be forgiven for up to 25% of the value of the. So once you are in the process of completing the application, you're going to have to be ready to sign a good faith certification. And that good faith certification is going to have to include a statement that ongoing uncertainty due to the current economic conditions is what necessitates the need for this loan request, and that the loan is necessary to support ongoing operations. That the borrower will use the loan request or the loan proceeds to retain workers and maintain payroll, or to make mortgage, lease, or utility payments. That the borrower does not have an application pending for a loan that would be duplicative of the purposes or the amount applied for in PPP. And that from February 15th, 2020 to December 31, 2020, the borrower will not be seeking a loan, again, for a duplicative purpose. And here is a sample of the application for the PPP loan. I just want to touch for a moment on the economic disaster injury loan program, which could be an alternative to PPP. And since we're expecting the PPP loans to be oversubscribed, in other words, since we're expecting that there will be more demand than there are resources to meet, you may want to consider an economic disaster injury loan as an alternative to PPP. So these loans can be up to $2 million of financial assistance. The borrower has to be in an area covered by a disaster declaration, which New York State is. The actual loan amount must be based on the economic injury suffered as a result of the disaster. And borrowers have to be in existence in January 2020, have fewer than 500 employees, and most nonprofits exempt under Section 501c are eligible, whereas PPP is limited to 501c3 and 501c19 organizations. Most organizations eligible under all of Section 501c of the Internal Revenue Code are eligible for economic disaster injury loan. So here are the loan parameters. The maximum loan is $2 million, and the interest rate for nonprofits is 2.75%. Unlike PPP, which is a 2-year term loan, these loans can be made for up to 30 years. All payments on the economic injury disaster loans related to coronavirus will have payments deferred for up to a year. Up to $200,000 can be approved without a personal guarantee, and approval will be based on a credit score. And it may be possible that you need to produce tax returns. Now, since nonprofits don't file tax returns the same way a business does, but it's possible that your 990 will be requested. Borrowers do not have to prove that they could not get credit elsewhere, and collateral is not required for loans of $25,000 or less. For loans of more than $25,000, generally collateral will be required. And again, to contrast with PPP, there's no personal guarantee in a PPP loan, and there's no collateral. It's not yet clear whether nonprofit organizations would be asked for a personal guarantee in an economic injury disaster loan, but I think it's important to note that where there is a personal guarantee, then that individual is responsible for repayment of the loan in the event that the nonprofit corporation is unable to make repayment. So you really have to think about it very hard whether or not you as an individual want to provide that guarantee. And borrowers must allow the SBA to review tax records. Now, there is an emergency economic disaster injury loan, and applicants can receive up to $10,000 in an emergency grant within 3 days of application through December 31, 2020. And there's no obligation to repay that $10,000 grant. To receive it, it's not necessary to have an approved economic injury disaster loan. However, if you are able to secure the PPP loan, that $10,000 grant will be subtracted from the amount of loan forgiveness that you're eligible to get under PPP. So thank you so much for joining us. I'm really hopeful that this was helpful to you. There are FAQs, frequently asked questions, posted on ESD's website. We will refresh those as time goes on and as we learn more about this program. So I urge you to check back with ESD frequently to get updates on this program. Thank you.